Hello and welcome everyone. This is John Person, and thank you for joining me in Las Vegas. And at the time, for those in the front row that couldn't see behind them, it was like a waiting line to get into the room. Apparently there was 15, 20 deep out in the hallway. There's standing room, people sitting in the aisles. So as we had one problem after another, of course, people started to leave, which makes sense. At one point I thought, wow, what happened to my computer? And as you all know, it turned out it really wasn't my computer. It was the internet, it was the projector, it was the cord for the projector. So anyway, they had switched that out after we had left the room. So in any event, what it did is for those who stuck till the very end, I made a promise if you filled out your information, we would email you contact in regards to the presentation in its entirety. And that is what we're doing right now. More importantly, we are going to host and conduct a follow-up webinar, which is what I normally do this Monday or Monday after Thanksgiving, December 2nd. So watch for that in your email. What we're going to do there is look and run through some of the scans using various platforms. So what I wanted to do was to, in an educational process, give you some steps of what we use, how we use them, and then how do you apply them in your own trading with different various platforms. So let's get started. All right. So first off, the markets have risk, and I want everyone to understand this is an important risk disclosure statement. This information is copywritten. It's for your personal information and educational purpose only. Trading does involve risk of loss, and of course, past performance is not indicative of future results. There is no warranty of profits as a result of using these or any other methods, and that would be the most important element in the fact that the next bullet point, that stop losses do not necessarily limit your losses, as some of you have found when the market gaps higher or lower, especially during earnings season on individual stocks. So let's get going. All right, so many of you have seen this. This book, Mastering the Stock Market, did win the Stock Traders Almanac Best Book for 2014, and the book was dedicated to me. It was quite an honor. 47 years in publication, the Stock Traders Almanac. Basically, some of the techniques that I use, very simple. Let the winners run, cut the losers, apply discipline to wait for setups to come to you. Go with the flow of the market. Watch these seasonal trends, and of course, technical analysis help. But what kind of technical analysis? And that's what we're going to discover together here. In order to understand what you're about to do, it's very important to understand where the market has been, and more importantly, there is a report or an indicator that we can find out who's actually in the market according to certain markets, specifically the commodity market. So if you're trading the S&P 500, the Nasdaq gold, if you're trading crude oil, natural gas, or you're trading like markets that have a high beta or stocks that are correlated to those underlying commodity price movements or have an inverse move like bonds to TBT or bonds with TLT. Most people are trading TLT, which is the price component ETF. TBT would be the yield component, which has an inverse relationship to price. So if you're trading bonds, it's kind of important. Are the commercials long or short? Are the large hedge funds long or short? And are the small speculators long or short? So if you're trading those specific markets, we do have an indicator. It's called the Commitment of Traders Report. Then to look at the present, if you're trading stocks, we have an exclusive. Every different segment of the market has kind of their own special indicators that many people aren't really aware of. So for example, as I just mentioned with commodities and commodity-like stocks or commodity-like ETFs, we have the Commitment of Traders Report. Next, if you're trading just stock indices, we can comprise and put together what we call the market internal factor and look at for example, the advanced decline ratio, the advanced decline comparative ratio line on each individual respective index. Then we also could look at, for example, the volume associated with that move to see if the price is sustaining momentum, if there's attracting more increase of participation, and that makes the rally a little healthier. So that's what we are going to look at today. All right. Next, we also look at the supply and demand and price targeting, and we look at futuristic levels of that by taking a look at seasonal analysis and pivot points, which we're going to talk about today. Okay. So, the first thing we're going to talk about is a little bit of what you really can't scan for in a computer to find out what is happening now, but what you can do is look at some of the seasonal analysis, and there's several publications, whether it's the Commodity Traders Almanac, the Stock Traders Almanac. There's several tools and software companies that provide seasonal trends of the marketplace that you can look at, not just what's the best time of the year that makes an annual high and low of a market, like crude oil or gold, for example, but also as well as certain segments of the market or sectors of the market, such as pharmaceutical, as well as the energy complex, as well as biotech, as well as metals and miners. So there's certain segments of the market that seem to perform best during certain times of the year, and that you can get a lead on what sector you want to start to focus in on, and then you can kind of nail down and target your technical analysis criterias, and that's one of the things that we can use to line up, so to speak, like a little playbook and get prepared before a market starts to move. That way you can get in on a low risk, high probability entry rather than chasing the market after it's already taken off, or maybe listen to the news as the news says, oh, there's big sector rotation. Look at this big move we saw in this one area of the market. So I'm sure everyone has heard that term before, sector rotation, as well as looking for asset reallocation jargon. So volume indicators can help uncover that participation. So it's not just price movement, but it's also the volume associated with it. And one of the things that, while we were talking as we were having all these difficulties, one of the things that we shared with everyone I polled the audience and said, how many people are having problems struggling with this concept of volume and price? When you have volume histogram and you see a long uptrend in the market, volume's on a decline, people think that the trend's not sustainable. And you'd be amazed at how many people in the audience raised their hands and said, yeah, they struggle with this. Well, the interesting aspect is, due to maybe potential dark pools, ETFs, optionable products on ETFs as well as individual stocks, guess what? We're not seeing the volume come into the marketplace on an individual stock as we would, or a commodity or an underlying derivative market like we used to in the old days, because people can in fact just do a synthetic long position in the market, as simple as selling a put and buying a call, and that's a synthetic long position. So that trade right there is not going to show in the underlying product. So if you were trying to buy Microsoft, for example, and instead of buying Microsoft, I could sell a 35 put and buy a 36 call, or I could look at some type of a synthetic strategy like that, and now I'm net long the market. So that volume that I did in the option is not going to show up or reflect in the underlying market. Same thing goes with the S&P 500. I don't have to buy the futures. I don't have to buy the ETF. I could sell a put and buy a call. I'm net long the market. So those are some of the areas that I think we have to pay attention to. Where is that volume going, and what indicator can help us to maybe develop a better sense of the trend of the market as volume, because that's a little different concept. Rather than just looking at individual volume bars, looking at the trend of the volume, we got an indicator for you just for that purpose. So it'll give you a better gauge of the health of the market. Next, in futures markets, we have open interest analysis, and as we mentioned earlier, for individual stock indices, indices, we have breadth analysis. So my top indicators and studies that I like to use, first off, are the Commitment of Traders CFTC report. And then I like to look at specific indicators specifically targeted to health and breadth of stock indices. So I like to look at a volume indicator, and I like to look at the advanced decline of each respective index. Next, I like to look at moving averages, and what everyone does is you do look at moving averages. They smooth out price moves. Now, the key is we have an open, a high, a low, and a close. Most people look at a moving average based on the close. Well, we also have some other variables that we could use, or parameter settings. We have the pivot point, the high-low close divided by 3. We also have the range divided by 2, high-low divided by 2. You also could take the open, the high-low close divided by 2. So we have many different combinations in which we could take a moving average of. It's just a matter of what does that moving average tell you about the market. So, for example, if we take a moving average of lows, it's going to tell us if the market breaks that moving average, you have a breakdown of support. Conversely, inversely, if you have a moving average of highs and the market breaks out above the high, what happens? You've got a breach of resistance of that moving average, thus the market's got a bullish momentum. So it's going to give you different readings depending on the inputs that you give, and of course the shorter the time frame of the moving average, the more sensitive it is to price moves. So for example, if you have a 10-period moving average, it's going to give you trend changes a lot quicker than, say, a 200-day moving average. So the next component that I like to look at is, of course, seasonal analysis. It gives me an idea of what sector should I be looking at getting into and what sector is starting to lose its seasonal strength. Next, I look at persons pivots in various multiple time frames. We have created on several different platforms daily, weekly, monthly, option expiration, and as well as quarterly time frames. Momentum, that's the other thing. We like to take a look at closing prices compared to past price action. We have a couple proprietary patterns that we published, the high close and the low close doji, for example, and we like to look at the combination of where the close is as it relates to past highs and past lows. And of course, one final element is comparative relative strength. We used to call them in the old days just simply spread charts. So this is the topics that we want to look at of the best of the best and the scan criteria that we can develop. So we need to, number one, take a look at what's available out there. So it's not only important to understand who's in the market, but what is the participation, the up versus down volume, up issues versus down issues, especially when you're looking at stock indices. One needs to confirm and compare with different time outlooks as well. So you're not just looking at one time frame. You've got to look at weekly and daily. What's the overall trend of the market? So multiple time frame analysis is also very important, and it's very easy to do. So let's talk about the health studies or the volume studies. And one of the indicators that we like to use is the on-balance volume indicator. It's used to calculate and identify changes in momentum. The calculation relates the volume to price change. So it provides a running total of volume and shows whether this volume is flowing in or out of a given market on up days versus down days. Next, I look at, as I mentioned, the advanced decline comparative ratio. This is the difference of the NYSE advancing versus declining issue. It represents the number of advancing issues less the number of declining issues. Now, this is a key point here, folks, because many platforms only give you information on this right here, the advance decline of the NYSE. And I'm here to tell you that we are able to create an advanced decline not just on the NYSE, but as well as the other top stock indices. So let's ask you this. How many people trade the NYSE? Not many, but people are trading diamonds, they're trading the Qs, they're trading the spiders, the S&P 500, they're trading the NASDAQ 100, and they're trading the Dow Jones Industrial Average. So why can't we create a simple advanced decline comparative ratio based on all these different markets? And the answer is, with the right technical tools and comprehensive programming talent, you can. So let's take a look at what they really entail. So here's a chart in the S&P 500, and as you can see, we have persons pivots. Now notice here, these are weekly bars, but notice the length. Each bar, each candle represents a weekly time period, 1 week, 2 week. Notice that the persons pivots are, you'll see, one of the best indicators is that on a quarterly basis. And for the fourth quarter of 2013, notice that it's targeting 1804 and a quarter. Now that's not an absolute, because notice that back here in May we penetrated that resistance. It was a level, an area of resistance that you want to pay attention to. Even back here in the first quarter, it penetrated it, not by a whole lot, but what it did is it gave you, with a PPS, that's that green arrow that I'm pointing to right here, it gave us the idea that the market was bullish, and this might be the potential high of that time period. When we concluded that time period, the person's pivot study, or the person's pivots, I mean, gave us a higher red and a, as you can see here, and I'll do this again. So notice that we have a higher red and we have a higher green. So that tells us that as we concluded the end of the first quarter, the second quarter was going to be in a bullish continuation, or a bullish market condition. So let's confirm, as prices are on the move and they're going up, as prices are going up, look what's happening, the advanced decline. Stocks that are contained within, and this is an exclusive advanced decline as it relates to the S&P 500. So we've taken all 500 S&P stocks and we've said, listen, if the market goes up, are more stocks going up on a cumulative basis with the index? And as you can see, clearly it was. Now here's another neat thing. This is the on-balance volume indicator. And with on-balance volume, it's a line chart. And as you can see, clearly the volume, when the market was going up in price, clearly you're seeing higher highs, and we're seeing higher lows. So clearly this indicator was in an uptrend in the market, confirming this solid price move. Here's the problem. Many people were looking at the volume histogram bars, and as you can see, I'm not, I'll take it off, but literally that little line there. But everyone can clearly see that, except for this one given week right here, which was a down week. If you line it up correctly, that was a down week in the market. It had a high move on volume, but it wasn't sustainable, because the very next week, what happened? We had the market broke out and made newer highs. And look at the on-balance volume. It starts to move up with that 4 or 5 week rally. What did the volume histogram bars do for you? Nothing. Gave you confusion, and you felt that this market couldn't go any higher. So the combination, it's not just looking at price, persons pivots, but looking at the breadth of the market and looking at the health of the market, that gave us great forecasting techniques. Then finally you get a little sell signal as we move out of June. Market moved lower 1 week, bang, right back into a buy signal. So let's take a quick look at this buy signal. This buy signal right here. Well, notice that the advanced decline started to uptick again at that same point. Notice that the on-balance volume started to uptick again. Notice that volume histogram bars didn't tell you a thing. You couldn't get any information out of that. And what happened? We ensued a further rally. Then all of a sudden we started to pull back, but yet we did so with the volume. We did so with the advanced decline. But notice that now the volume starts to pick up again. So this is kind of a, for me, using the histogram volume bars, it's just not as effective as using on-balance volume when it pertains to a stock indice such as the S&Ps. Now notice that as we look at this chart together, you'll notice that, number one, persons pivots is still giving us a quarterly bullish outlook this entire year. And we've confirmed that price move with the advanced decline making new highs, and we've confirmed that price move with the rise in on-balance volume indicator. Whereas the histogram bars have given you no assistance this year and may have confused you. So with that said, I think what we take away from the volume histogram bars is to say, gee, are we seeing individual sell-offs? Is it a potentially, how I view this, is every time we got these little red candles, guess what? We got very strong readings in the volume histogram bars. And as you can see, even here, we have one strong day. That was a doji, actually. It didn't even go down that week. But as I've lined up those weekly bars, you could see, okay, maybe that volume is saying it was a capitulation, a blow-off, or perhaps just people just had hopes of the market going down and they just all sold. And then as soon as the market started to recover, you knew that there were shorts in the market. And so that's one of the techniques that we would say that the volume histogram bar is good for nowadays, but it certainly is not effective in looking at the overall trend or the health of the market. Okay, so let's move forward. Next, this is the Russell, and it's a very similar situation. As you can tell here, the Russell has broken out for the upside with the advanced decline, broke out with the volume on the on-balance volume reading, on a trend of lower volume. Meanwhile, here we are making newer highs. So what is a better confirming tool than, say, not only does the person's pivot study, which is this buy-sell indicator, there's a green arrow right there which tells us that the market's moving higher, but then person's pivots, looking at this, this again is a daily chart, as it shows right here. You'll notice this is a daily chart with the monthly pivot. This is a monthly time frame. So that's another important element. And then I'll go back here and share this with you. How do I line up the person's pivots? People often ask me that. So if I'm looking at my quarterlies, I use the weekly chart. When I have the daily, I'm looking at monthlies. Now, if I'm day trading, I obviously look at the dailies and the monthlies, because just like here, notice that in every given trading month, we have one day that's going to mark the potential low of the month, and we have one day that's going to potentially mark the high of the month. And so with that said, it's important for a day trader to see, hey, if the market is supposed to be in this kind of range for the month and you're day trading, I mean, market goes up, goes down, goes up, goes down, but you know, at least as a day trader, you know you're at a higher degree time frame resistance. You're not taking buy breakouts, you're actually selling against a higher degree time frame resistance level. That's one of the important elements that we like to really instill in our student bodies mindset when they start to trade in the market. Okay, so let's move forward. Seasonal analysis and the indicators and pivots. Seasonal analysis that I talked about alerts us to potential changes in supply and demand outlook from a historic perspective, and on-balance volume gives a read, a tell, if there is buying on dips or selling on rallies. And of course, pivot analysis, the way I created and just explained, gives us a conditional outlook whether the market is bullish or bearish, and it does so in advance at the end of a time period, and it projects the next time period's market condition, and under that condition, it gives you actual price targets to look for. So again, person's pivot indicator and the sentiment indicator, how does it work? Well, we use a short-term pivot point against a long-term pivot point, or longer term. And if you think about moving average theory, if a short-term moving average is above a longer-term moving average, then the market outlook is bullish. And that's all this was based on. I used moving averages, but I used the moving averages based on the pivots themselves. The pivot is a formula that is created. If you came to that event in Las Vegas, there's a little booklet on page 2, gave the formula to you. And that formula will share with you that the essence of the formula of the pivot point is derived from taking the high, the low, the close, and divided by 3. And that gives us our typical price for the next session. Okay? So we created, many people use the floor traders, and there's no doubt about that. But few people used weekly back when I was really teaching this in advanced ways. And monthly certainly wasn't something until I brought it to the attention. And then, of course, one of the things is option expiration, and quarterly pivots is one that I've used for quite some time. Quarterly pivots I've used since the early 80s, in fact, when we were looking at interest rate changes in the 30-year Treasury bonds. So that's a little bit of history and how we can use some of the pivots and incorporate that in our planning and scanning. So here's a chart. This is daily bars with monthly persons pivots. And this is looking at the XLE, the Energy Select Spider. So notice that underneath in the middle bar we have on balance volume. And then finally we have the seasonal trend of this particular market. And you can see this is on balance volume and this is the seasonal trend right here. It says so right there. All right, so you could see clearly that this is the time of the year the market goes up, the market goes up. Then typically from on or about May into mid or late October, the XLE starts to decline. Well, this particular year, we didn't really see a decline per se, but we kind of did. From the peak in price, when we're supposed to peak out, we actually did kind of do what? We just moved from that peak to that trough was lower. So again, the seasonal trend worked. Now we start to enter, as we get into October, into April, the strongest time frame of the year. And as you can see, we're already starting to move up. So part of what we look at is, all right, we're at pivot resistance, and perhaps if we get into the month of November, we'd be looking for the XLE to give us some kind of a breakdown. Here's a different look. This is the daily bars. I just wanted to share this with you. Daily bars using the quarterly persons pivots to find out the relevance of the quarter pivots. And as you can see, it doesn't give you the exact low, and it gives you kind of the exact high, gave you the exact low, didn't quite give the exact high, but I think you're getting the idea that it gives a pretty decent, accurate reading that the market condition has been bullish. And so with that said, except for in this time frame right here where the market really didn't go anywhere, it gives us a good idea of when not to be selling and when not to be buying. For example, if we're in a seasonally strong period of time, then look to buy against support. As we get into that seasonally weak period of time, possibly take a profit. And so there is one of the ways that we can say, gee, it's supposed to be a bullish environment and be contained in this price range. This is what's really neat about the persons pivots, because it not only gives you a market outlook, bullish or bearish, but it gives you those price definitions or defined price targets in a specific time and place. Okay, so let's take a look further at the stocks that are contained in the XLE. The top 10 holdings, we have Exxon, Chevron, Schlumberger, ConocoPhillips, Occidental Petroleum, Apache, Halliburton, Anadarko, and Marathon Oil. Those are the top names. So now that we have the XLE in a seasonally strong period of time, then it's going to be weighted, or it's going to be geared towards some of these top names having influence on that sector. So it's up to us to maybe run a scan. How do we run a scan? Well, real simple. We can run a scan using several different platforms that tell me in this time frame if I get a weekly buy signal, a weekly PPS, that's that green arrow right there, tell me I get a weekly buy signal. Now, if I get a buy signal, I want you to go right down the line with me, and I want to take a look at this volume. Notice that we had a 2-week move to the upside. So let's look at this and examine this carefully together, all right? So from the low here, we got a buy signal, and then the following week, we have an up move. So almost in 3 weeks, we have an increase in volume, don't we? This really doesn't tell me anything, to be honest with you. In fact, look at the overall trend of the volume. It's down. But look at the overall price action. It's up. Look at the overall price or volume action using on-balance volume. It's quite a different tell, a different reading than using volume histogram bars. So with that said, we are able to use a scan feature that says, gee, we're in a seasonally strong period of time. Let me go and see what stocks look good, and more importantly, what stocks are in a buy mode and what stocks are in a buy mode with an increase in the volume action. So you need both to confirm. You need, if the price is going to go down, and volume is down is a different story. If the price goes down but then pops right back up, then and we don't have a sell signal like over here, then guess what? It's probably still in an uptrend. It just says that you need to move your stops. And we have specific stop entry techniques that we teach, especially my proprietary or patented, not patented, but coveted last conditional change that I've written about in many of my books. All right. So far, I hope you like what you're seeing, and at least it's a lot better than what we did together at the Las Vegas Traders Expo. And again, I have to blame the company and the lack of technicians there, not the Traders Expo, who were really trying to work hard at getting all the computer problems together that existed at Caesar's Palace. So I don't think it's a reflection on the Traders Expo as much as possibly Caesar's Palace. So with that said, this is Exxon. Notice we have a clear buy signal right here. Clear buy signal. And notice as the market moves up, it moves up on an increase in volume. But notice the volume histogram bars. I don't know about you, but I don't know what to say here. So, I mean, it's not a great move from 86 to 92, but this is a very short order in 4 little weeks. At least you know, and you have the ability to say, gee, yeah, the market is, John, your person's pivots in a bearish bias. Why would I buy that buy signal? Because we just talked about that we are entering a seasonally strong period of time, and so we want to run a scan for buy signals in this sector. That's how we put it together, and then let's confirm that buy signal by saying, gee, are we seeing an increase in the volume as it relates with the on-balance volume indicator? Okay? All right, so let's move forward. This is Halliburton. Same thing. This is the end of October when it enters a seasonally strong period of time. Not a great mover, but it's on the right track. And as you can see, again, another example of the difference between on-balance volume and the trend of the market versus the market price going up. And I don't know what you're supposed to get out of this. So even with that said, I mean, clearly we have a downtrend. This might be a little uptrend, but overall, clearly you can see the decline in volume, and it just isn't as helpful and useful, except for maybe individual week or one time frame to see if it came on heavier than normal volume. But to look at the volume histogram bars as a trend reading tool is just not as effective as looking at on-balance volume. Okay, let's move forward. So the other indicators, relative strength comparative analysis. What does this mean? Basically, we compare the performance of one product versus another. Many people would take a look at the euro currency and say, gee, look, it's higher. It's higher what? It's higher to the U.S. dollar. You're comparing relative to the dollar, the euro is worth more than the U.S. dollar. But how about Microsoft versus Oracle, or EMC versus Akamai Technology, like companies within a sector or a group? Or more importantly, is this sector relative to, is the XLE relative to the XLV? So is energy relative to healthcare outperforming? Is there a better percentage gain in one versus the other? Those are very easy to do, and I think everyone was kind of amazed to even see this type of research and analysis, but it's very common. It's called relative comparative strength, and what the key is that you want to learn how to start at certain times of periods. So what this chart represents is the beginning of the year. All right, and as you see here, we have the IIX, which is the Internet Technology Index. IYT is the transportation. KRE is regional banks. I'll get to that in a minute. The spiders, S&P 500. XLB is the materials, energy, financials, industrials, technology, consumer staples, utilities, healthcare, consumer discretionary, and emerging markets, just to throw it in there. So the S&Ps at the time, the beginning of, or first week of November, when I had to prepare this presentation for you, the S&Ps were only up 20% year to date. But if you look at the consumer discretionary, they were up 29%. The healthcare was up 29.6%, and it was the KRE, and it was the transportation, all up more than 28%. These four groups exceeded and excelled all other segments of the market. Now,
You may have heard emerging markets was a great time to invest, probably back here at the beginning of the year. How many you may remember hearing, oh, in emerging markets, great time to buy. Well, here's the thing about relative strength. This is a zero line from the beginning of the time that you start. This is the beginning of time. As a market starts to go from negative, okay, negative to positive, back to negative, when it starts to go and break out of an old high. So we want to focus on this blue line right there. So you buy stuff, money chases money. Positive performance chases positive performance. And as you can see clearly, even the green line right here, this is the KRE. What does KRE stand for? Regional banks. Regional banks has actually outperformed the XLF, the financial. And the XLF is not a pure bank play. The XLF, in case you did not know, is a diversified financial element because it contains the CME, which is a commodity exchange, American Express, which is a credit card company. It also has Metropolitan Life, which is an insurer. Yes, there are banks like Bank America, Wells Fargo, and Citi, but for the most part, it's not. The XLF is not a pure banking play. What we're seeing on looking at this relative strength is looking at individual sectors become the biggest and best performers. Notice this little dark red, which is, of course, the transportation. You can clearly see that if you look at this, it makes, as it breaks out of one high, right? What we see is it goes and does what? Makes higher highs and higher lows. Sorry about that. So higher highs and higher lows. So let's take a look together. There's a high, and as soon as it broke out of that high, it made a higher high. And as soon as it broke out of that high, it made a higher high. And as soon as it broke out of that high, it made a higher high. And it did that because why? It was above the zero line. So when would I be looking at emerging markets? I would look at emerging markets when it gets back above zero, starts to prove itself, and then starts to make higher highs. That's the point I'm trying to make. Now I can say, gee, is this one sector that seems to be outperforming everything else? Is this in a seasonally strong period of time? Is transportation, which is really moving? Is consumer discretionary, which is really moving? Are these areas that from about early September or even late September, as you can see here, are really starting to gain traction in the marketplace. So that will help to target my focus. So if I got a lineup of seasonal analysis and relative strength, then I have a better odds of following what the institutions are doing. So those are some of the techniques that we use and some of the indicators and studies. Now, using the same techniques here, these are the slides that I presented to a technical analysis group in Munich this past, we call it München. It's spelt München, but we call it Munich. So in any event, using the relative strength, I wanted to go over there and say, hey, listen, by the way, guys and girls, ladies and gentlemen, the S&P 500 right here is outperforming France, Germany, Italy. The worst performing sector is Latin America and emerging markets, and of course Malaysia. These are the exact slides, as you can see, that I was there in September for their presentation on September 9th. So with that said, I said, you know, we're going to be seeing, as long as if we take out this high, and again, the same theory that if you make a product or a market that has been above zero and continues to make breakouts and higher highs, that's what you want to do. You're going to probably see moves. Now, the S&P 500 at the time in September was only up 15%. It took out its high of 17%, and we're probably up around here, 26%. So a big swing to the upside. So what I was talking about as money follows money. What about emerging markets? It's still negative on the year. Why? Because it's not gained traction above the zero line. Okay? So with that said, these are the things we can kind of focus in on and say, gee, if it's positive, it's a no-brainer, right? I mean, what better way of putting an edge in your pocket than to say money follows money? You've heard that term before, most likely. And so positive performance attracts more performance. Now, here's one of the interesting concepts, taking a look at a specific time, and I told you that we could take a look at different sectors and different times, and I just had it from the beginning of the year. So let's take a look at the this particular shot was where we were in September at that event. And I said, listen, right now, if you take a quick look on my indicators here, the XLB, which is right here in this color, right, we broke out of the high. And taking a look at the XLI industrials, as you can see, we just broke out of the highs as well. We are now looking to see a bigger move, and for that, we're starting to see money pouring into materials and the industrials. So we want to take a look at that, I tell them. And I go out there and I say, gee, here's a great company that's in the DAX. Now, again, I'm in Germany, so I was trying to appeal to, their markets for them. And I said, here's a great stock opportunity. We have a nice move in as far as a PPS buy signal, right? The market's in a weekly buy. It just kind of had a little pullback here, and it's starting to break out. And the volume's starting to move up again as we see a rise in prices. So this is a stock that would have probably, by placing stops underneath the swing low here, we would probably see some continuation to the upside in this name. So the funny thing is, I think a lot of people, when I got to that, they said, no, it's Siemens. It's just been going nowhere for a couple years there. And I said, yeah, but things are different now because the market's in a seasonal strong period of time, A, and B, we're starting to see money move into that sector. So now's the time to get on it. I understand what happened in the past, but you got to think of past, present, and future. The past was a past. The present, we're starting to see conditional changes. And the future, we're starting to see seasonal analysis look for higher moves. So here was when I was there. Weeks later, this is where the market for Siemens, as you can see, this was that particular week. We did get a nice move in the market. And the funny thing is, most people might not, if you do look up at a chart on Siemens, and the stock symbol, of course, is SI, even to this date of the presentation, you'll notice that Siemens has actually gone up to a high of about 132. So we had a nice little move there by picking the right stock, the right sector, by looking at the technical tools. Now look at this. If I was an average investor or maybe an institutional trader who did not learn or know about the on-balance volume indicator, what do you see here? Wow, isn't that special? It's going straight up. What do you see here with the volume histogram? Nothing. It wouldn't be on my radar if I was paying attention to these bars. It would be like, oh, it's no big deal. It's not going anywhere. It doesn't have strength to go. It's going nowhere, right? But by looking at on-balance volume and say, whoa, wait a minute here. It's going up. It broke out of this old high. It's making higher highs, right? You see what I'm sharing, or did I put too many lines in there? I got crazy with the arrows. So look at the old highs. And we started to break out here. And we made each consecutive move, made an up move in price with an up move in volume. So that is a very good tell and a reading. So, all right, you don't want to trade Siemens. I'm telling you, this is just a pure example of before and after that trade setup that occurred with what I'm trying to teach you right now and to a professional group in Munich, in Germany, this past September. So pretty powerful information, and it's very effective. So one of the other elements that we like to look at is, of course, candlesticks. And candlesticks, because of their color, because of the relationship of the real body, which is considered between the open and the close, and the real body's color, green for a higher close than open and red for a lower close than open, and the shadows, which is the outside range, high or low, that's above or below the open-close relationship, and the size and length of those shadows, all right, the length of the shadows, and the overall length of the candle. These are all very important elements, and one of the things I wanted to share with everybody is, if you're a day trader, one thing that I ran a backtest study in my second book, and was the first in the world to actually do this, was to find out, at least with the S&Ps, the mini S&Ps, the relevance of the day low on a 15-minute candle. How many times did the low of the day form a doji? And how many times was it a hammer? For the high of the day, how many times was a doji? For the high of the day, how many times was it for a shooting star? Now, 30% was for the low of the day a doji, 40% was a hammer, combined 70%. For the high of the day, 36% of the time we saw highs formed by, on a 15-minute intraday basis, 36.4% actually, so the computer rounded down to just 36%, and then it was 40.2%, something like that, so it round up. So 36 and 40 is not 77, but if it's 40.4 and 36.4, then the computer rounds up. So the bottom line is it was very relevant to find dojis and shooting stars, okay? Here are the dojis, of how often they formed and what the frequency was, because that gives me another statistical edge in the marketplace. It wasn't random, so to speak. So that's how I came up with the conclusion years ago. I wanted to be a trader that could find the most high probability trade pattern ever. If the market was going down and we saw one of the most formidable bullish patterns was the morning doji star for a bullish pattern, and I was looking for that, but the only problem is I never found it. And sometimes you'd see the market chop around a couple times, forming a little consolidation on a trend, right? It's a little choppy, goes up, goes down, goes choppy, and then all of a sudden we'd form a doji. Well, that's what I noticed, that the market that closes above the high of the doji, typically it will be near or the low is the doji of that time frame. So what we did is we would look to be a buyer on the close or the next session open, and we should see immediate results. Immediate results also mean if the market's going to start to trend higher, we should start to see higher lows and higher highs. So that's what we came up with the high close doji pattern. So why do I bring that to your attention? Because it's important that we can run scans for these types of patterns, and that way, if maybe we don't get a PPS buy signal after a downtrend, we're near support in a seasonally strong period of time, we might get that high close doji first and foremost, and that would be an incredible edge in the market. So do they ever happen? Well, if you just look back on what happened into October, this is a real picture. You could look on any platform, everything we talked about today. Advanced decline goes up, on balance volume goes up. Look what kind of pattern formed, and look where it formed near. Monthly pivot prediction. That's right. We had a high close doji combined with a PPS buy signal in the S&Ps back in October of 2013. So yes, we do look for these trades. Do they happen every single month? No, but all you need is 1-2 good markets a year, and it's worthy of seeing an end of day high close doji or a low close doji. So with that said, these are the things that we can use to scan, and these are the technical tools that we can use as scan criteria to validate or confirm that this move has sustainability to it. Okay, so is the market moving up, and is it moving up? Notice that this is the E-mini S&P, and look what this says, ADCSP, Advanced Decline Comparative Ratio for the S&Ps. So I'm comparing an apple to an apple. I want to look at all the stocks in the S&P 500 versus the stocks that are contained in the NYSE, which most people only look at the Advanced Decline Comparative Ratio on the NYSE. And I'm here to tell you, it can give you a different reading. All right, the low close doji is quite the just simply the opposite of the high close doji. So after an uptrend in the market, right, what do we get? Market chops around, goes up, goes down, goes up, goes down, and all of a sudden a doji forms, and it's the candle that closes within 3 bars after this doji. That's typically when we see a sell-off. Your stop goes above the high of the doji or the highest high of the last 4 bars. Typically on an uptrend like this, typically the doji marks near the top of the move. It's that close below the low of the doji that accelerates to the downside and gets that loss of positive momentum and reverses to negative momentum, causing that downdraft, that sell-off, the one that if you're short or looking for a trigger to get short, that's the trigger. All right, so here's a nice little screenshot. One of the things that just lets you know what we've created is a way to set alerts off. So notice what it says right here. It says JP LCD futures, and it tells me it's a 5-minute. It tells me that we have low close dojis and at earlier time periods, right? So what we're looking at is a single chart page with multiple time frames. So what we have is a 1 minute, a 5 minute, a 15 minute. This happens to be the 60 minute and a daily chart. So with that said, let's take a look, and what we can see here together is that on the 5 minute chart, look at all the low close doji. So we're going to get these alerts and these pop-ups that says, hey, by the way, here we've got at this time period, we have a low close doji and it's a 15 minute. Ooh, now I might want to pay attention a little closer to that. Or we get a 5 minute low close doji. Okay, so I'm in a low close doji within a low close doji, so I might have a better shot of getting a sell. And so can we get alerts? I'm here to tell you we've created it. So yes, you can get alerted, because I don't know if you're watching multiple things and all of a sudden you say, oh man, I was watching crude oil today, or I was watching Microsoft, or I was watching LinkedIn or Twitter, or I was watching all of a plethora of a multitude of markets, and guess what? I missed the trade. Well, that's why we do have alerts that are set up and constructed in this fashion, okay? So it's available. Now, this is an interesting chart because just in case people don't believe the pattern. So after an uptrend, now typically you get a little bit of consolidation. So as you can see, this is not your typical evening doji star formation. It's not. It's a double doji star, but what does it mean? Well, look at the doji low and look at the next bar's close. It is equal. It's not less than. It was 1, 2, this bar right here that's got the PPS indicator. Notice that the close, which is right that red line, is way below the low of that doji. So it was, truthfully, it's not the fact that a doji does mark indecision, but it's the close of a bar below the doji within 3 bars, as you can see here. There we go. There's the low of the doji. So clearly you can see that right here we close below the low of that doji. That is what triggers the short of the market. Okay? So the setup is the doji. The triggers the close below the doji within 3 bars. All right? That's the LCD setup. So trading versus technical analysis. Now, we need to be better analysts. And I know for option strategists there, you're constantly taking and hearing the term adjustment of positions. How to adjust a position. That's like when a position doesn't go well. Well, my theory and the way I was brought up in the business was have better analytical skills and you'll do less adjustments. And so, you know, there's a certain time and place for an iron condor. There's a certain time and place for a stock replacement strategy, or a stock replacement strategy both long and short, so which is buying in the money call or put options. Then there is a time and place for diagonals, calendars. All types of option strategies out there are under the assumption that the investor or trader feels he has compelling evidence that a market's going to do one of 3 things: go up, go down, go sideways. There are several different aggressive directional strategies, like a ratio back spread. If you're in a seasonally strong period of time, if you have great volume, a good indicator, and you're in the right sector, so you could put down, to have better use of your capital, a great strategy that's more aggressive into the marketplace. So instead of doing, oh, I don't think the market's going anywhere, I'll do an iron condor. Well, if you looked at, we had a high close doji and it's on increasing volume, we're near pivot support, that might not be the greatest strategy, especially in a time period where we see seasonal strength come in the market. So with that said, I think it's really a neat thing that we can come together and say, folks, there are some indicators out there many of you aren't used to. And I just wanted, the hour that we have to spend together is very short-lived to give you 33 years of technical and trading experience. But I do want you to know that these are the tools that are available. I think the one key word that I said at this conference was logic. A lot of the the information that I am showing you today is based on pure logic. It makes sense that if a market's going to go up, have a tally of the volume comparing up days versus down days. That makes sense, right? Then, number two, it makes sense to me that if I'm looking at the breadth of the market, why, if I'm trading the spiders, I'm trading the diamonds, and trading the Russell, which represents blue chips, benchmark with the S&P and small cap stocks, then why am I looking at the advanced decline of the NYSE? Because what if we see this sector rotation come out of technology into small cap, back into blue chip? I want to make sure if the market is seeing newer highs, is all the stock indexes making newer highs with an increase in participation as the advanced decline illustrates in each respective index. That's important information. I'm sure you agree with that. For all practical purposes, this may be hard to review, but on the top line are all daily charts. And I'll just zoom it up. This is the S&P 500. And as of the time of the recording, we're starting to see a little bit of a doji formation on the E-mini S&Ps. The volume levels aren't really participating with this upside move, and we are starting to develop a little bit of bearish divergence in the market, which is very interesting. So what we want to look for is if the market breaks a low, not just in price, but if we break the low and we break that advanced decline level, then it's going to show bearish divergence. Right now we do have bearish divergence in the sense that we don't have higher highs in the advanced decline, but we have higher closing prices in the sense that from when this peak was made, market pulled back, we made higher highs, but we don't have a thrust or participation in the S&Ps. So let's take a look here and share with you the different makeup of the market. So this is the NASDAQ 100, and the NASDAQ kind of confirms the same thing. We saw higher highs, but not with the advanced decline. But volume picked up here. Look at on-balance volume. That's kind of interesting. So we're going to be taking a look at, and this is where it's very important on a day-to-day basis, just to look at your charts. This is the Russell. All right, we're using the Russell futures, but ADCRT stands for Russell. As you can tell, we haven't quite penetrated. We've made newer highs. So you're starting to get the idea that several, in fact, let me go back to that and share with you this. This volume is a little bit, even on balance volume, as the trend of prices moving up, it's actually showing a little bit of bearish divergence in the lack of sustainability or participation in that market, which may give us a lack of sustainability before another correction or some type of correction is due. So this is the NYSE, and yes, while we're starting to see a little bit of a potential rounding top develop, notice that the advanced decline is not, we're not seeing a breakout with newer highs that we had over this course of this period, right? So here's the course of the period, and guess what? We're not seeing newer highs in the advanced decline. So we can, I'm just sharing with you that we can take a look at each individual stock index. Now this is the Dow Jones Industrial Average, the diamonds, and one of the interesting components is that every chart that I showed you, the markets are all getting near a very important resistance. By the way, remember that high close doji that I mentioned in the E-mini S&P at monthly support? This is the diamonds, by the way, the diamonds ETF. Look at that beautiful doji right there, and there's my proprietary candle setup right there. What happened when this market had an upside move? Well, it had a bigger move with the volume. So if I just went down straight away and I just lined everything up correctly, you could see higher high in volume, breakout with advanced decline, and we had a price move to the upside. And so a very nice confirming situation. So right now, we're looking at the health of the market right now. We're not seeing a lot of volume pull off as we near new resistance for the year, and we're not seeing, we will want to see if we get aggressive moves to the upside in the Dow or the diamonds. But we formed a doji here as of November 26th. We're very cautious of the market for good reasons, and I think that's one of the things that I think everyone should be able to take a look at rather than guessing where a market can go. Now, let's take a look down below, because here we have, for example, a weekly bar with those quarterly pivots that I talked about. And notice the weekly here, and I know it's only Tuesday, but we formed a doji and we're flatlining on the advanced decline. So I'm just going to go down and share with you, looking at the NASDAQ, it's near quarterly pivot. The Russell, not quite at it. Looking at the NYSE, almost at quarterly pivot resistance, and the diamonds are at quarterly pivot resistance. So we're at a longer term targeted resistance. We've been bullish the market, but now I have to say, it's time to tighten your stops up. Be careful, and since implied volatility is so cheap, this might be a good time, since we are at resistance, that we could see a pause in the market a little bit for whatever reason. So in the next 24 days till we get through at least from this time with this video recording, December options for you equities traders have 24 days till expiration. January have 52. So if we pause a little bit, we get into Black Friday, Cyber Monday, and don't forget Cyber Monday, we're going to host another webinar as a follow-up to see what you got out of this information, show you how to run some scans, give you an opportunity to take advantage of an incredible special that we had at the trade show we weren't able to offer you. If you're interested in learning more to accelerate your education, I would say we would love to have you participate in this incredible offer. It's just incredible. And when I say incredible, I put together an options trading course and I put together the stock trading simplify. And for the show, we didn't get a chance to introduce this to people, but both of these products are available on our website. However, they are not at that price. So we have a special link for you, a special address. If you'd like to take advantage of this, the Stock Trading Simplified course, which includes seasonal analysis, it includes all the techniques that I've just shared, including the construction of on-balance volume with a moving average, how to put that overlay there. If you're interested in the seasonality of the different sectors, if you're also looking to brush up on your options trading from a 30, and in fact, it's not my life passion, it's kind of my life. I started trading options in 1984. So the first commodity they ever introduced options on was on the Treasury bonds at the Chicago Board of Trade, and that's where I cut my teeth on learning about options and option strategy. So these are amazing courses. They're very powerful courses that will help you and give you a set of skills. Not only we talk about specific entry techniques and tactics, limit orders, placing limit bids, limit offers in the market, as well as stop-in techniques. We talk about how to identify trade setups, order execution techniques, and how to, more importantly, effectively place your stop-loss order. Remember, we talked about that last conditional change candle and how to exit without hesitation. So these two courses combined are extremely powerful. Great way to end the year. Take advantage of these for our Cyber Monday deal. And more importantly, we will see you at our webinar on Monday, as well as we follow up with how to run for scans using this type of information. Now, here's where you can find this fantastic information. Go to www.personsplanet. Let me get it right here at the top here. www.personsplanet.com /Vegas, VEGAS Expo, right there, .html. If you go to my regular website, you will not find this product, these courses, for that price. In fact, you will find them at an incredibly, almost triple that price. So this is an amazing savings. We did this for the trade show. We couldn't offer it because the presentation couldn't be seen, so we're extending it for you. It'll be through this weekend. Sign up, take advantage of this. This is incredible, powerful information. I believe my goal is I can dramatically change and impact the way you trade the market, and that's why many people have taken my courses. And that's why I think you guys have come to Las Vegas or came to see me, because you wanted to find out more fantastic educational information. Take advantage of these two courses right away. I'm telling you, you will not be sorry. We'll follow up Monday. In fact, after the close, we're going to have a special webinar on how to run specific scans and We'll go through that information with you. Love to have you be a part of our educational family and to help you be on the right side of the market. And that's one of the things that I could tell you. Both of these trading courses were put together to help investors like yourself really come out on top. So with that said, that concludes our time for today. Take advantage of this special offer, personsplanet.com/VegasExpo.html. Thank you all very much. In conclusion, if you do want to get a hold of us, it's just email us johnp@personsplanet.com. The website is personsplanet.com. We'll look forward to seeing you on Monday. Happy Thanksgiving, everyone. It was great to meet some of you one-on-one in Las Vegas, and I hope that this webinar that you and I just went through helped to clear up a lot of the questions and share with you some of the neat stuff that we do here. Everyone, take care now. We'll see you Monday.